Hello, good morning. It's a Friday, and that means it's another episode of the Making Finance Fan podcast, episode 7, no less. Hello, Clive. How are you?
Good morning, Neil. Happy Friday, as always. We're back once again, and looking forward to this one. This is going to be good. I can't believe episode 7, 7 in a row, every second week. We're fairly consistent. We're very good.
Just about. No tech issues this week. We're cooking on gas. We're buzzing. It has been 2 weeks since the last episode. What have you been up to, Clive? Anything interesting?
Anything interesting the last 2 weeks? Well, the weather has been absolutely miserable, so it's just been a good opportunity to get down and get to work. But apart from work, and what we've done is gone and set up a new YouTube channel. So just following in your footsteps. And so I set up a YouTube channel called Clive Hand, the QuickBooks accountant. I didn't know really what to call it, to be honest with you, but I just said we'll throw that. It could change, but it's going to be a channel where we're going to host the Making Finance Fun podcast, some Ask About Business podcasting questions, Q&A sort of thing, and QuickBooks tips and tricks and things like that. So that's on the way or in progress. We have a QuickBooks Online webinar coming up next week on Tuesday, where we're looking at advanced reporting using QuickBooks Online. And then we have another one in 2 weeks' time with the ACCA, in conjunction with the ACCA. So looking forward to that. That's all going to be good fun.
Amazing.
What about your end?
A YouTube channel. I'm still beavering away on getting mine up to date. We've done some exciting things over the last couple of weeks. So I've uploaded episode 1 of the podcast. I've uploaded some of the other videos that I've been doing. I'm getting a really exciting good friend of mine to edit some of my 30-day video challenge stuff. So yeah, I need to put a bit more time to get it a bit more up to date. But the reason why I've been a little bit slack on that the last couple of weeks is because I bought a business.
You did not.
I did. Bloody did. I bought a business. I might have hinted about it on the last episode ever so slightly that something was bubbling under the surface. We have bought an accountancy firm about 10 miles south of us. Owner is kind of winding down, looking to retire. They have come across with 2 other members of staff for a period of time whilst we transition. And we've got another 100 or so clients to service. So we are now a team of 8 with about 300 clients now. And I tell you what, I knew it was going to be hard work, but yeah, the last couple of weeks have been brutal. And we're making good progress. So if you think about all the stuff that you might need to do, so changing letter of engagement, setting up a new direct debit, appeasing clients who clearly had no idea, appeasing team members who clearly had no idea, getting out and about on the road and seeing people. We're not changing any services or any fees, so it's kind of business as usual, just with a different name on the top of the door. So yeah, there's lots of stuff to do, lots of systems to kind of roll over and change, tax authorities, all that kind of jazz that you would normally expect with a new client or a kind of a new onboarding process. We're just doing it times 100, which and as you probably know, we're already pretty busy anyway, so a bit of a glutton for punishment. But that's kind of been my sort of bag for the last 2 weeks. We've got a job offer that's been accepted for somebody who I've been talking to for on and off for about 6 months. So they're looking to start in October, which is very, very exciting. That was always going to happen with our organic growth. So can't wait for them to come on board and kind of help support the growth of the business alongside all of the acquisition stuff as well. What else has been going on? If you're watching this on the video, if you're listening to it on audio, you can't, but someone's wearing a nice swanky England football top. We might be in the final of the Euros again, Clive.
Like,
I know
okay,
you didn't care, but
I really don't care. Yeah. Have you seen the pictures of Roy Keane every time England scores a goal? Yeah.
Well, I was going to say to you, there was a video that went up after the goal on whenever it was, on Wednesday, and Ian Wright and Gary Neville, typical, just absolutely, apoplectic, like, jumping, shouting. Gary Neville's high pitched voice when he's excited is hilarious. And then Roy Keane's just stood there with his arms folded, just kind of like, not even a smile. That's brilliant.
Yeah. Look at fair play to them. They've got through to the final. I have no idea how they've managed to scrape the results that they've had to get to where they are. They've had like three really good super moments. You had Jude Bellingham's bicycle kick to save your backside against, was it Slovenia? Then a local lad, Watkins, pops up like with a minute to go and twist of a hip and a right boot and into the bottom corner and into the finals. I have no idea how they've managed it, but yeah.
It's a
Look, and
very
I, I'm
it's a
just,
very
I'm just.
tenuous link with a very tenuous link with Ollie Watkins, that he was on loan for like 3 months at Western Supermare Football Club. But we're going to take it, absolutely.
I'm just waiting for England, right, to be runners up in the Euros, and then in September, when the Nations League starts and England come to Dublin, we're going to wipe the floor with you.
Is that right? Okay.
I hope so.
Who's your star player at the moment?
Oh, well, we got 15 of them. There's so many of them. It's just so hard to kind of name them all. We don't have a lot of time here, so I'll just say collectively, they're a good bunch of guys.
I think you find 15 is rugby, isn't it, Clive? Like, footballers tend to play with 11 on the pitch.
Yeah, but we have a few spare lads we throw on there at the end.
They all go and go, yeah? Oh, dear.
Well, they won't have to, the way England performs, but anyway.
Well, there you go.
Time.
There you go.
All right. Okay.
Yeah, so that's been kind of it. Oh, well, we're also rolling out onto a new billing platform called Socket, which most people probably won't know, but a good friend of mine, Jonathan Gaunt, who owns an accountancy business in Bristol, he is renowned for creating software and it being quite good. Alongside running a busy practice, I'm not quite sure how he does it. So our existing billing platform of Ignition, we're looking to kind of move alongside the acquisition and a job hire and all the other kind of jazz that we're doing. But we're rolling all of the new acquired clients onto this Socket platform. So it's a good project for one of the new guys that have come across to kind of cut their teeth on. And then we might have had some sort of an election or something happened over the last week as well. I don't really follow politics. Well, I don't follow politics or any sort of current affairs unless there's a budget announcement or there's something financial that I need to let clients know of. So yeah, we'll kind of move swiftly on that, I think. Probably doesn't affect you as well, does it, mate? Really?
It might do. Depends from a Northern Ireland point of view. If more economic supports are going to be put into Northern Ireland, which they probably are, given the fact that of its location on the border to the EU, so it could only mean good things for that region, and as a result, trade between the two areas. So all good, hopefully.
And I guess you do a fair bit of work as well, cross between the Republic and Northern Ireland as well. So yeah, I didn't think of that. So yeah, okay, interesting. So that's that. I'm kind of like looking over here every now and then if you're watching a video, because I'm just keeping an eye on the Facebook group and comments that are coming through. And we've got some people. We've got Christian. Hello, mate. Hope you are okay. And he says Ollie Watkins, WSM finest. Yeah, absolutely. Hello, Keith. Good morning to you. And hello to you as well, James.
Good morning.
Regulars of the show now. We're getting a bit of a posse, which is good. Good to see you guys.
I love it.
And I'm also crossing across LinkedIn every now and then as well. So if you're watching on LinkedIn and you're watching live, say hello. If you're watching the repeat, let us know anyway. Drop a comment in. And if you've got any questions and you're here live, drop them in the comments. We'll try and pick them up as I kind of multitask, which is difficult for me at the best of times. If you're watching a repeat and you've got a question about today's session or just in general, pop it in the comments and we will hopefully address it on a future episode, the next one. But we've got lots of ideas. We've got some interesting themes coming up, and I was talking to Clive last night around things like property, both lettings and mortgage, things about insolvency as well. Met a really good guy yesterday, a good friend of mine, who really wants to come on and do some stuff around insolvency, which is a difficult topic. I guess, emotively, but nevertheless important. Might not be a making finance fun session. We might have to get rid of the fun bit on that episode. But yeah, but today, episode 7, we are talking about financing your business, and I've got to kind of preface this by saying that, for me, I guess this is going to be more about an overview of, I guess, kind of what's available, but sort of at a summary level. And the reason I say that is because we at NDC partner with a organisation called Swoop, and they are a corporate finance provider, supplier, partner, and they do all of our, I guess, what you could call financing activities, in terms of, if a client wants finance for a vehicle or plant and machinery, or they want a bank loan, or they want to know if there's any grants, funds, investments, that kind of thing. And my main guy there, a chap called Sam, he wants to come on to the podcast to do a bit of a deeper dive. And I thought that was quite cool. Clive, I think you thought that was quite cool. So that's going to be kind of like, treat this as part 1, and then we'll get a date in for part 2. So I'm going to kind of tell you roughly what stuff is in this one, and then the other one is just going to be, the kind of the core stuff, the important stuff. Well, I mean, I guess in terms of, what business finance is, I don't know, Clive, do you want to kind of kick off with your experiences around business finance, and I guess why we think it's essential for, well, all businesses, but I guess specifically startups and new businesses?
Yeah, so I think it's really important that business owners tend to be afraid of this area of funding and finance. They're not sure what the options are around it. But ultimately, it can be a kickstarter to your business, because you could have a great business idea and you need some resources in the business, whether it's people, it's mechanical, it's whatever it may be, technical, and you need some funding to get that up and running. So, as Neil's pointed out, today is just about looking at what those options are and some tips around how you can get started on that journey of exploring your funding and financing options in in the business. And when it comes to this, it's all just down to proper planning as well. And when you're looking at funding, there's different types. You can go down the debt route, which is your traditional banking, or you can go down the equity route, which is about getting investors in on board with the business. And when it comes to equity financing, people go, oh, surely if I have a small business and I'm trying to grow it, and I take in somebody as an equity partner, does that mean I lose control? And that's not necessarily the case. So it's really important that you work with your accountant or advisor, or even the guys, Sam from Swoop. Like, geez, that's mega to have Sam to want to come on board and give deep dive into the financing options for a business.
We've had to pay a big fee. We've had to pay a big signing on fee, appearance fee to get him on. There's a lot of negotiation, but yeah, I think we got there in the end.
I think it'd be well worth it. I think it's very well worth it. Yeah. So look, we want to have a look today, just basically a rundown of what business finance option is, why it's essential for startups, what your different options are. I would just have a conversation around the pros and cons and some tips about what you need to know if you do decide to go down this route. So that's it, folks. Let's get stuck in.
So I guess probably over the last couple of years, it's been easier, or I guess the access to funding and to finance has been easier to obtain, because obviously during COVID, a lot of a lot of kind of ways of financing sort of closed down. But I've definitely seen since, well, probably sort of tail end of 2021, a lot more opportunities have arisen. It's still very difficult to obtain financing, and we'll talk about the kind of the different types later on. But I guess in terms of, why a business might want to have funding or financing, it could be a variety of reasons, but I guess the common ones that I see is that they have like a set of objectives, and they know that, let's say they're creating a product, for example, and it could be, I don't know, a drink or some food, and so therefore they need some capital in order to create a formula or a recipe in terms of the actual product, in order to kind of meet the objectives in terms of what they want. So it could be something to do with health criteria, or it could be like an energy drink or something which maybe has health properties, or it could be, I don't know, like a ready meal kind of concept. Whatever they're trying to create, they have to kind of almost, it's like chicken and egg scenario. They have to create the product when not necessarily they have the money to do that. And then there's kind of like everything that sort of wraps around that product. So, they need to understand the marketing, because, okay, great, they've created a product, but, unless they can market it and they sell it, then they're not going to recoup any investment that they've had in order to make the product. So there's lots of different bits and pieces, I guess, that kind of hang around that. And you could say the same thing about services. So, if I take one of my clients as an example, they're creating a technology platform which enables students to coordinate house views with landlords. And on the flip side, it allows landlords to scope out potential tenants, students for their properties. So it's kind of almost like a dating app for students and landlords. It's a great concept, but the proprietary technology and the software needs to be developed. And these guys are super young, and they've had to go out and they've had to get investment. And I guess in terms of like external investment, there's two key areas. So there's equity financing and there's debt financing. So we'll go into the two and kind of in a bit more detail in a minute, but very kind of summarized level, equity financing is raising capital, so like an investment round with investors, for example, and there's debt financing, which is a big fat stinking loan from a bank, kind of thing. So borrowing, effectively. But there have been, I guess, more, well, different methodologies. Certainly, maybe over the last, I don't know, 10, 15 years. So, I mean, bootstrapping is, that's what I've done. So, bootstrapping is basically putting your hand in your own pocket and kind of organically growing a business. Now, I never had thousands and thousands of pounds to start my business. I had like 400 quid. Not everyone has got £400 to start their own business, but I did. And everything that we've grown since then has come from that seed £400, but that came from my own pocket. So bootstrapping is quite a popular way. And kind of following on from that, there's maybe friends and family that can invest, which is kind of like a type of equity financing. But if it's friends and family, you might be able to, you might give away some equity, but some of it could be like gifts, for example, like from parents or whatever. So that's kind of like a form of bootstrapping in my eyes. And then there's the one that's become really popular over the last 10 or so years is crowdfunding. And I don't know, I think even though it's been like a while since it started, I think there's been a bit of COVID culture around crowdfunding, because it seems to me, if anybody's got an idea, especially with the rise of social media and kind of technology and sort of online, ever-present, real-time systems, if somebody's got a decent idea, they'll go out to, I don't know, Crowdcube or I'm struggling to think now. There's probably two or three other main. Can you think of any more, Clive? Like crowdfunding platforms? There's a few, isn't there? Like main ones. But Crowdcube is one
Yeah,
I've heard of.
there's crowdfunding, and then there's like peer to peer, which is becoming a lot more popular these days. Like if you want to personalize the crowdfunding perspective, think of a GoFundMe page. If somebody has an accident or something like that, and they issue or they create a GoFundMe page, or you could do something similar. And there's platforms out there that focus and do that type of crowdfunding for businesses as well. So
Yeah,
they're there, they're available as well. Um, I suppose it's also important to say that like there's such thing as like good borrowing and bad borrowing as well. If I could just throw that in there, in terms of why people may borrow. So it's always very important to make sure that you're very crystal clear and you've confirmed that the reasons why you're borrowing. So Neil's kind of touched on it there exactly. Like if you have a proof of concept for a product or a service, and then you have something to go to market. And what the funding and the borrowing does, and whether you go down the equity or the traditional bank route is, it just accelerates that movement to go to market and build a business. So I always see funding as a good thing if it has a good outcome. So that's kind of the question. So ask yourself why. Why do we need borrowing? It's because of X, Y, and Z. What's the outcome? A, B, C. Does one pay for the other? Absolutely. Then that's good borrowing. Okay. There's such thing as bad borrowing. That's when you're just trying to keep your head above the water. And that's effectively what I would say is actually burying your head in the sand. But look, at what we're trying to do here is just focus on the good borrowing, I suppose, for today.
Yeah, and another kind of crowdfunding platform I thought was Patreon. That's become quite popular, especially
Ah,
with like artists, like music artists, where they can offer maybe up some content for like a regular monthly subscription cost. That's a good way of raising money. Albeit you kind of have to produce something, and it tends to be more service based than product based. But yeah, cool. Just checking the comments. Keith says first time watcher. Amazing. Thank you. He's popped his making finance fun cherry. Good for him. Kerm says hello. Kerm is actually the guy who's going to be coming on board to talk about some insolvency stuff, who I met yesterday. So hello to you,
nice.
Kerm. Keith says, glad you got me here, Neil. This is information I really need. That's amazing feedback. Thank you, mate. Like I said, this is kind of more of a summarized version of what is available and the different types of financing and investment. And you could need £1,000, you could need £100,000. I think the next session that we'll do with Sam, who's coming on from Swoop, is kind of the really kind of nuts and bolts around, well, this is the exact process and this is what you need and this is the history that you might need, maybe some credit, all that kind of stuff. So that'll be a really interesting session as well for you, Keith. But let's chat more about equity financing. So I don't know about you, Clive, but kind of when I think about equity investing or equity financing, even I'm talking about investing because I'm thinking about angel investors. I'm thinking about like Dragon's Den. Is that what kind of like springs to
Yeah,
mind when you think about angel investors? Not the things
I,
with wings, right?
I said there's no way we're going to get through this session where Neil mentions angel investors and doesn't say Dragon's Den in the same sentence. It's just not going to happen.
Well, I mean, it's on my notes, mate. Like Dragon's Den, for those that are watching a video, it's on my notes. There you go.
I'm
I
sure
love.
Stephen Bartlett's in there as well. Have you got it written on
He's
your notes
not.
too?
He's not. He's
No.
not.
Oh,
I could have put him in there, couldn't I? Okay. Well, let's just say it now. Dragon's Den, aka Stephen Bartlett. But there you go.
okay, okay. And Stephen still has an open invitation for the podcast, by the way.
He does. He does. I saw a post from him on LinkedIn this morning saying that he's just invested. As we're on the topic of angel investors, he's just invested in a recruitment firm called Chapter Two. And I saw the video. It's all whizzy. It looks really, really cool. So he might be a bit busy at the moment, Clive. We might have to go back to him.
Right. Okay. Okay. We'll put that in the long finger. Yeah. So equity investment. What is equity investment? It's basically where you get capital or money in exchange for some shares in your company. Okay. So that's really important to note that angel investment or equity investment is aimed at or geared to companies rather than sole traders initially. Okay. Yeah, angel investors, who are they? What do they look like? It is Dragon's Den. It's those guys in Dragon's Den. Angel investors are probably the guys that get involved at the early stage, at the startups. They're the guys that are going to take a big risk on your business because you have a proof of concept or you're new to market, whatever kind of stage you're at in your business. They invest their own funds, or maybe they have a fund behind them, but they'll invest funds into your business for a certain project in return for a certain level of equity and maybe profit share, whatever maybe that comes with, depending on what the agreement is. But the thing I like about angel investors is not only are you getting their funding, but my idea of an angel investor is you're also getting a mentor or somebody who's a coach who specializes in a certain area. So that might be taking a product from proof of concept to a finalized product, to the market, maybe it's distribution deals, whatever it may be. But the idea My understanding of an angel investor is somebody who invests money into your business, but you also get them as a mentor as well.
Yeah, I've kind of hinted at a closer relationship. It's more, I guess it's more. I mean, you can have a number of angel investors within a business, but I guess it's more one to one, isn't it? It's more of that. Like, I'm not just going to give you money. I'm going to give you a little bit more to kind of help out because it's in their interest, right, for the business to work. So
Yeah, absolutely. It's like they are. Excuse me. They are taking a big punt on you, on the product, on the business. So it's in their interest to for them to come into your business or take their team into the business along with them and help you achieve those targets or objectives that you're looking to achieve with the funding. And I suppose they're ensuring that they're going to get number one, that they're going to get their funds back, get a return on them funds, and possibly benefit from the uplift in the value of the business as a result of the activities that came with the funding as well. So I think as a startup, if you're looking at the equity route, for whatever reason that may be, then probably reaching out to angel investors is a good starting point, right?
yeah, and also I think a lot of people see the word angel investor and they think, oh, I need like a super massive business, or I need like a really big concept, or I need, this new business has to do at least 1 million turnover for an angel investor to get excited. But that's not always the case. I don't think. I think you can have a really decent idea, and start small, and that could be, I don't know, 30 grand a year, could be 100 grand a year. But if the concept is solid, and you've got a sound business plan, and you know what you, I guess you know what you want to deliver in the business, but also you're super passionate about it. I think that's the main thing. And I keep saying, like, you've got to be super passionate about what you do. I think if that comes through, then angel investor could invest a smaller sum of money for a smaller business. I don't think it necessarily has to kind of be at that sort of upper tier. I don't know what you think about that, but I think
Yeah,
that's
I'm actually just curious to see what the success stories were from the Dragons then. And like, we're not talking big businesses here, but what we're
no.
talking is small startups that turned into a big business, like the craft gin and gin club and bubble club that kind of make your own home kit. Like, do you remember during COVID? You couldn't get a pint or a gin and tonic, so they'd send you out a cocktail kit. That's pretty cool. Reggae sauce again, like hot spice sauce. It's not. We're not talking like the Dells and the Microsoft and the Apples of the world and all of these startups. Like there's a book, right? Wonderfully, dads turned entrepreneurs. Children's
That's
books,
us.
business
That's us,
idea.
right? That's us, right? Dads turned into entrepreneurs. Yeah.
I suppose so. I suppose so. Yeah. So, like, I'm a big fan of angel investments and angel investors because they partner with you with their funding. I think that's the big thing for me.
Yeah, and whatever the future may hold for any of us, I've always said that I love to get involved in projects. We help a lot of charities and communities here within Western Superman. We do other things as opposed to just accounts and tax. So I think if you find somebody that's as passionate about you, but in a slightly different industry, then there are lots of people out there that will potentially put their hand in their pocket, back a concept, and maybe like to go down that kind of mentoring, kind of coaching route. There's lots of people out there that will help with that. But I guess that's kind of like the softer side. That's the more personable side of kind of equity financing. And then for me, there's like the cutthroat, very challenging, quite difficult, often reserved for higher businesses, maybe kind of not really relevant for viewers of this, but and that's private equity or venture capital, like whatever you want to
Yeah.
call it. I worked for 5 years in a veterinary company, very, very successful. Probably the best job or jobs there that I've ever had. An amazing culture and atmosphere at the beginning, not quite so at the end. But that business when I joined was probably 50 million a year turnover, and generally the concept was it was a business that was funded by a private equity company. So kind of a series of investors or a fund that was managed by a specific separate business that gave the veterinary company a shed load of money and just said, buy veterinary practices, consolidate them into a larger group, and you do it successfully, and we'll keep giving you more money. And for me, like as we got bigger, the culture dissipated. It got very cutthroat. It was all about the returns. We were refinanced with different private equity businesses, probably three in those 5 years. And each private equity firm wanted a better return on their
Yeah.
capital, and they were investing more money. And we're talking like multi millions in terms of money. So this kind of like for me, it's reserved for like the higher sort of size of business, the larger business. But for me, there was so much control, like so much control, very stifling in terms of an atmosphere. I've already mentioned about the returns. You know, when we were being refinanced, it was like a team of 20 people came into the office to do like a mega audit. It was so like ruthless what they wanted to know to then, you know, give more money. And it's really quite like regulatory driven, if that's the correct sort of terminology. So, like I said, it's quite stifling. There were lots of things that you could do, and a lot of things that you couldn't do. Um, I don't know. Have you got any experience with
Yeah.
private equity, Clive?
Yeah, so when I was a financial controller in a design and manufacturing company, they went from 100% kind of family ownership to selling like 51% to a venture capitalist firm. And you could feel that in the run up to that agreement happening, there was a lot of emphasis in putting the right systems and controls, both operational and budgetary and financial, into place to make that happen. And after the deal had gone through and it was a big success, there was definitely some pros and cons. So let me talk about the cons first, right? High level degree of regular financial reporting and strict adherence to budgets. On a lot of pressure. I kind of echo what Neil has said there. Not pressure, but as such, but the main focus is that say these guys come in at tier three venture capitalists, like the low end, because they're taking over a private stake in the business. Like their gig as a tier three venture capitalist company is to build the company to the next tier and sell it on to the tier two venture capitalist guys, right? So if you've got a company that starts off and they're doing like 20 million a year, then the next target is 150 200 million a year. And when they get to that stage, then they can realize their investment in you or your business, and then they can sell it to a tier two. And that tier two will then look to take that company from, say, a quarter of a million to half a million. No, 250 million to half a billion. And then the tier one guys will look to take it from a half a billion upwards. Okay. So the company's always under kind of I would say not scrutiny, but pressure to deliver on those financial targets on behalf of the venture capitalists. And they would normally sometimes send in their own team there to help and support and grow that company. So what's the con or the pros? Pros of venture capitalism is capitalism is that you get access to capital, you get access to expertise as well. So what you're looking at is you have a team of venture capitalists that will come into your business and they'll say, look, we know how to take you from a 50 million company to a 250 million euro company. We've the expertise and the experience to do that, and we've done that time and time again. And here's the playbook. Here's what we need to do to make that happen. Okay, so that's definitely the benefits of engaging or working with venture capitalists. Is that if you want to have a legacy or a company that grows, you don't have to sell 100%. Like my experience was, they retained 49%, and that company is now $1 billion company 6 years later. So from
That's
about
crazy.
20-30 million a year to $1 billion is savage growth in 7 6 7 years. And that has all been part to the hard work that's been done by the team in that company, but also by the guidance and experience of the venture capitalist investors as well, providing them the structures to build a company to that scale. So that's definitely the pros.
Yeah,
So
that's
yeah,
huge,
that's
huge
amazing.
growth. Yeah, well,
Yeah,
you know, the veterinary company, we went from 50 million turnover to a billion in five
yeah.
years. I don't know, like 60 veterinary practices to 1,000. You know, UK into Europe. So yeah, it was like huge growth, and it was accelerated by those funds.
It just scales so fast, doesn't it? It
Yeah,
really, really does. Like Like if people know, the company I'm on about in Dundalk now has two major plants in Dundalk. They are huge buildings. You can't miss them. But fair play to them. They've done incredible work, and the team there has done just an awesome job, really.
Yeah.
So that's venture capital, private equity.
Well,
Um,
go on.
well, just private equity. I'm assuming is funding from kind of like friends, family, other business owners, I suppose, if you want to put it like that. Here in Ireland, we have some revenue backed private equity schemes whereby if you invest into a company, then there is tax relief on the value of the investment that you put into that company. And then that scheme also allows you to withdraw your funds after a certain period of time as well. That's really, really good that there are schemes like that. They're called EIIS and EII. And you can find that people gather together to create these schemes to invest private equity into companies. And there's some really, really good tax havens for those investors who do the private equity route through those revenue approved schemes as well. But it's just an ideal way, again, to gain capital, gain funding, hand over a bit of control, but then to reverse that at a later stage once you've met certain business targets as well.
Yeah, I think like in the UK, I mean, one of the because they're called something slightly different. So you got like SCIS and you got VCTs. I mean, this is typically like a financial advisor's wheelhouse, not an accountant, especially here in the UK. But I know my financial advisor; he has mentioned about these strategies before, and we've kind of done these with our clients that we work with together. And I know that like SCIS, if you put in an amount of money, I think it starts at like £5,000, but you get a 30% tax rebate, which is great. You get 30% off your tax bill in terms of your investment, that is. So if it was £10,000, you get £3,000 back. And then that stays in for 5 years. If you're lucky, you might get paid a dividend every year, which I believe is tax free as well. And then you get your capital back, which hopefully has risen. Again, that would be tax free when it comes back, or you could lose it all. I guess that's the kicker in terms of the risk, because typically it's more kind of risk friendly companies. It's like tech firms or it's startups, and it's those that are a bit more risky. Hence the reason why you get a bit of a kickback on your tax bill when you invest. So don't put all your eggs in one basket, but it's definitely a good. And if you're a business and you were looking to, obtain funding via that method, you can go through the SCIS application. It's quite strict. Again, few clients have been on that. And once you gain that accreditation, then that opens you up for investors to invest in you through the SCIS scheme. And it is caveated. There's certain limits and there's certain things you can and can't do. But yeah, that's a pretty good thing to do. I mean, I guess in terms of like,
Oh, that's it. That's it's very, very similar to the scheme that I just mentioned. It's
yeah,
funny. Who's copying who? Is the UK copying Ireland or is Ireland copying the UK? It's the same gig. It's like you put your money in for a number of years, you get it all back out, and you got tax relief on the initial investment at the very, very start. It's brilliant. So it's ideal. Like I had a client a number of years ago setting up a company because he wanted to create an app, and then he was asking about this scheme. If he said his uncle wanted to invest in it, and I said, right, okay, let's have a look at this scheme because there's a financial or a tax benefit for him to do that rather than just hand you 15,000 euros. So it's worth having the conversations with an accountant or a tax advisor if you're starting a business like that and you have people who want to invest in your business. How can we support and help them do that and make it easier for them to do that as well? And there is schemes, there is like revenue and HMRC, as you see there with Neil, to allow and facilitate that to happen. So yeah, just make sure you have the right conversations before you go down the private equity route. Make sure you look at all your options first.
yeah. I think one con that we've not discussed, which applies to all of these methods, is there's dilution. So if you're willing to obtain money from a source, irrespective of what that is, you probably might have to give away some equity, and therefore Clive was talking about the 49, 51%. It can vary. Dragon's Den, they tend to want to give away 10% for 50 grand or whatever the amount is, but they are giving away 10% in that example of their business. So there is some dilution. There is, inevitably, if you want to pay out dividends, then some profit sharing that you'll have to do if you give away some of your company. So, that's kind of the trade-off for obtaining funds. And typically, I guess equity isn't commonly repaid. Most people want to have equity in a business because they can see a growth strategy and they can see it getting bigger, and they want a piece of that pie if and when that company eventually sells. And at that point, they might have their stake back. But typically speaking, once you invest in a company, it's for the longer term. So, which I guess is a pro. To be fair, that you don't necessarily have to pay it back in all instances. And the other big pro that we've not touched upon is the risk is shared. So, if you've got a dodgy concept or this energy drink that's like a massively way out there, but you obtain some funding, then if it fails, then the investor knows that they are investing their capital at risk. Not everything is successful. So if it's not your own money, then that kind of, yes, it's your time. You may still put some of your own money into the business, but you're sharing that kind of risk. So yeah, that's kind of like a couple from me. And then I guess what do investors look for? Well, I said about it before, but I think it's got to be a concept that the person that's pitching the idea has to be like super passionate about what they want to do, whether it's a product or a service or whatever. Because if they're not passionate about it, I don't think they can really expect an investor to be, excited about generating a return. So for me, investors are always going to look at payback. How long is it going to take for them potentially to either get their money back or to make a return that equals what they've put in. And there could be some strategic advantages, I guess, around I don't know, let's say for example, I invest in property, so I might want to invest in a lettings company or an estate agent because there's potentially some synergies there for me to work with. Or it could be geography, so like I love Weston-super-Mare, so I might want to invest in something that's doing something amazing within Weston-super-Mare because I want to benefit the local economy, and I might know the person, for example. So I think there's other reasons why like investors look to kind of go into business and to invest, not just from the kind of the financial side, but also kind of that strategic side, and if they can get excited with something as well.
Yeah, absolutely. And I think it always is important to put yourself as a business owner in the shoes of the investor and to really understand what's their as Neil said, their motivations, um uh their wants, their whys, those sort of things. For example, like you can take certain kind of pre steps to set yourself up for a successful funding round. Like for example, you could have a good, strong, experienced management team in place. You could have good. Like the financial health of the business is in good position. It's robust. You have projections. Like you hear that all the time in the likes of the Dragon's Den. What's your growth for the next 3 years? What's your sales projections? What's your profit projections? So having good, strong financial planning in place as well as the controls is super important there. Other aspects to consider from the investor's point of view as a business owner is probably that you have a viable business model as well. So they want to make sure that it's tried and tested. Your value proposition, like what makes you stand out in the energy drinks business against everyone else. So that unique value proposition is important. And then something that a lot of people don't consider as a business owner when you're trying to walk in the shoes of an investor is exit strategy. So a lot of the time when we're having these conversations, it's about how do we get funding from these investors, but you have to also consider how do they get out as well, and what does that look like. So a proper planning around those things is really important. I suppose the last piece then is what would you call it? Social proof, I suppose. Um, Show that you've done this, you've built a brand, you've built a business behind it as well. To kind of help sell it to them as well, that they can see it, they can feel it and understand it. And I suppose that would help you, taking those steps would help you as a business owner set you up for a successful round of funding. for equity financing.
Amazing. Awesome. So that's equity financing, right? So what about debt financing? Um, well, uh, like I said before, bank loans are probably one of the most popular type of debt. Like everyone hears the word debt and they automatically get like negative connotations.
It
Um,
sounds like dead.
it sounds like dead. Yeah, yeah, well,
Debt.
it does, doesn't it? But when you say, "Oh, I'm in debt," I mean, there's not really a positive sort of outcome of that. However, I think when it comes to debt financing, I think there's definitely a lot of positives that can be had, especially if you're either a brand new business or you're looking to grow either through acquisition or you've got a new sales channel or new product to market. I think debt financing could be really really interesting and probably similar to equity. I guess like debt financing was a lot cheaper during COVID. Interest rates were low. Now it's not quite so cheap. But still, like a lot of the bank loans that you can see on the market at the moment, depending on the length of term, you probably get like 7 to 10% APR on a standard loan. Again, depending on the term, depending on the amount. But I think probably debt financing is harder. I don't know what you think, Clive. I think it's for me, it's probably harder to achieve because you've kind of almost got to have that proof of concept already in place for a bank willing to part with some money. Do you think?
Yeah, absolutely. And it's I lost my train of thought there, but yeah, um, the bank lending has been easier up to probably COVID times, and then it did get strict, and it probably got expensive too with the ECB rates increasing, just like it did in the UK with the Bank of England too, as well. And there's always three concepts that when it comes to bank lending that the bankers want to be able to see. Number one is that um, you know, number one is that they get their money back, obviously, security. Number two is profitability. Can they make money off you? And then number three is repayment capacity, um, to to see if they can, if you're able to repay it back. But the problem is, or not that the problem is, but sometimes businesses get too dependent on lending and rolling over borrowings, and then sometimes you have the opposite, where the banks, especially here in Ireland, have just cut off lending and funding to businesses. And that's quite scary. So in Ireland here, they've introduced the concept of a strategic corporate banking, and basically, what that means or implies is that if you've gone to your bank for a business loan and it's been refused, you can then kind of apply to a government bank, who will provide lending up to 250,000 security free, which is great for businesses, especially those that want to start off and get a foothold into the market. Um, Yeah, but when it comes to like, it's probably easier to go and get debt financing by way of a bank loan because it normally involves a copy of your accounts, the latest management accounts, filling in an application form that goes through their system, and you get a reply in a couple of days. Nothing like private equity or equity investment, which could probably take a number of weeks or even months.
Yeah. I mean, I guess like in terms of other forms of debt financing, like credit. So credit card as an example is a form of debt financing, and people have credit cards. It can be dangerous, and when somebody says I'm in debt, then more often than not they've probably got maybe debt on a credit card. But credit can be like really interesting as well from a supplier point of view. So I don't know if go back to kind of the energy drink concept, and let's say for example you've got a retail shop or you want to sell online, then typically selling a product is relatively quick. Somebody places an order, you make the stuff and get it out, or you have a supply, you have a stock of it. But in terms of like making it and acquiring the ingredients, if you can obtain a line of credit with a supplier, so I don't know, whatever ingredients go into an energy drink, you get like 60-day payment terms with a supplier, then that's great because you don't have to pay for those materials for 60 days, but then you obtain them straight away and you generate revenue and you generate sales up to that point of 60 days, at which that point that will enable you to pay off the supplier and maybe order the next batch of materials. So, to manage cash flow and to help with accelerating money into the business and to create a product like that, then suppliers see it a lot with clients of mine. Line of credit with suppliers. Construction, for example. You go down Screwfix and you buy a load of electrical supplies for an electrician. Chances are, if he's lucky, if he's got a good history with that supplier, he'll get a line of credit, and it could be 30 days, it could be 60 days. But he'll go there, he'll order whatever he needs, he'll go out to the person's house to do the job, he'll get the money in, hopefully within a week or two, all while he's still got money to pay for the supplier. So it enables that person to do the job, it enables that person to gain the revenue. Without having to have that kind of outlay. And then it's all around cash management to make sure that you don't spend all that money on other things before you then got to pay your supplier. But I think, yeah, for me, like, line of credit with suppliers is very, very common. It's very, very popular.
I think,
I expect you see that quite a lot as well, didn't you, Clive, within like manufacturing and...
yeah, I think it's a very it's strange when it comes to lines of credits from suppliers, because what I'm seeing is a trend from suppliers reducing their credit terms from 90 to 60 to 30 days, and that's probably because they got a really clever accountant like us behind them advising them to reduce their credit terms. And then what you do see is that they're also introducing like automated payment options, so that when the 30 days is up or the 60 days is up, then the payment automatically goes through. And when you have those sort of payment options in there, it probably makes it easier to get longer terms of credit. But ultimately, businesses do tend to offer lines of credit to each other, especially when it comes to products and manufacturing and whatnot. So, yeah, use it. But what's really important on the back of it is to make sure that you're including them in like short-term cash flows to make sure that you have the funds to repay those suppliers when the time comes to meet their bills. So, like when I worked as an accountant in business, we used to do a 3-month rolling forecast every month. And basically, it was just to see what purchase orders were due in and to be invoiced, and what invoices were due to be paid over the next 3 months. And the idea was to say, do we have enough cash to pay all these people over the next 3 months? So it's very important that if you do operate lines of credits with suppliers, that you also have an accountant that helps you prepare 3 months. Why 3 months? Because nobody ever extends credit terms longer than 90 days, right? So in other words, at the end of the month, have we enough cash to meet the next 3 months obligations? But there's other sources of finance, like bonds and debentures. Not too sure what the difference is. Well, I do, but so a bond and debenture, the idea between the two of them is that you borrow a fixed amount for a fixed period, and at the end of that period, you return the money together with interest payments that are paid annually. Okay, so you could buy a bond for 500,000 with a 10% rate, and that means you pay back 50,000 a year over the 5 years, and then pay the full 500,000 back at the end of the 5 year term. Bonds and debentures are pretty cool for likes of large construction projects where you may have a project that lasts a couple of years. So you'd have a debenture or the project that would run, or bond that would run the same length as the project. That helps fund that construction project. The thing I'd say about debentures is that they are focused at securing collateral or assets. So they have what's called a fixed charge over an asset, which is normally a property that the company owns. So if the debenture doesn't get repaid after 5 years, it means then the property in which the charge is on gets enforced basically. Okay, so debentures and bonds are pretty cool because you don't have to pay a repayment every month as such. You have the annual interest amount to repay, and then you have the big lump sum to repay at the end of the year. So really good if you're looking at construction, or if you're looking at maybe you're looking to build a building or something like that. Sometimes bonds are pretty cool to use.
Yeah, and I think something that you touched upon there regarding security, I think it's been more common now, certainly since COVID times, that banks require a personal guarantee, irrespective of whether it's borrowing through a company. I guess no different to like a mortgage. So, you know, Nowadays, if you were to grow an investment portfolio and you want it solely through a limited company for tax reasons, you will still need to give a personal guarantee on a mortgage. And a lot of the loans, even if the loan is to fund business growth through a limited company, you will still typically have to give a personal guarantee. So I think gone are the days where you could probably just take a loan out in the company and not have that added risk of your personal house because it's the company, right? So if the company goes under, the debt goes with it. Very rare now do I see or do I hear of any suppliers or any lenders that will do anything excluding a personal guarantee. And then you mentioned about
Yeah.
interest, and I think interest there's a pro and a con to interest. I think the pro is that interest is tax deductible. That's a good thing. So it
Yes.
reduces your profit, reduces the corporation tax that you pay, but it's also a bad thing because you've got to pay interest. So I think there's kind of a double-edged sword with it, to be honest. But the main pro for me with debt financing is you get to keep 100% of the business. You don't have to give anything away to get a bank loan. Yes, there's guarantees. Yes, there's kind of fail safes if things go wrong. But you don't have to give away 10% of your business to obtain a 10, 50, £100,000 loan. And I think that's probably one of like the main pros for me, especially if you want to keep with control of the business. You don't want to give away any dividends, profit sharing, any of that kind of jazz. But then, on the flip side to that, you've got to pay it back with interest typically, and depending on who you speak to and the lender and the market fluctuations, it can be quite expensive. Obviously, short-term credit is more expensive than long-term credit. You've heard the likes of Funding Circle, and especially on credit cards, you've got like 20, 25, 30% APR interest rates. Like if you've got a long-term project, clearly that's not really the line of credit or the type of debt financing that you need or require. And then, clearly something like a house, you're not going to buy a house on a credit card. You're going to have something relatively long-term. I've not heard of a credit card that gives you £250,000 kind of worth of a balance, because the interest on that would be crazy. But yeah, I mean, like everything to do with debt financing, like maybe more specifically tailored towards the smaller business as well, I guess. And Clive shouted out some larger businesses. I guess that's more like the bond and debenture side. And there are loans that you can get that are, small millions of pounds, I guess. But yeah, I think kind of more typically for the smaller business. But any advice around debt financing, typically, speak to a professional. Like guys like us can let you know about, I guess the different types of debt financing and kind of roughly what the kind of the mechanics of them are in terms of the accounting and tax treatment. But one of the reasons why we're getting Sam from Swoop on is because he will have that kind of laser focused steer and insight in terms of the different options that are available. And like anything, market conditions, government changes, whatever you want to say, things, rates, products, services, they will all change. So it's difficult to keep on top of things. Hence why I partner with Swoop to kind of manage that for me. So there you go. So we've spoken about equity financing. We've spoken about debt financing. The only other one that we were talking about the beginning is kind of the wacky stuff, right? The alternative financing. Start with crowdfunding because we spoke about that a little bit just then. Have you had any experience with crowdfunding, Clive? I've had a little bit personally with crowdfunding that I've done, but have you? Have you invested in any like wacky concepts?
No, no, actually, every time I see like, oh, invest in this water bottle for €10 and we're going to sell it for like 300 quid. So you're getting like €290 discount. No, I'm not too sure what's in it for either party. And I'm not too sure of the companies that I tend to see that are seeking crowdfunding. Like, I'm just not too sure about it. I haven't looked into it deep enough to kind of assure myself that it's probably the right route. Maybe you've more experience in crowdfunding. Like the
A
when I
little
think of
bit.
crowdfunding, I'm thinking of like looking at like raising money for a school, something like that, rather than for a business.
Yeah, I mean, well, funny you should say that. One of the preschools locally did a crowdfunding exercise to fix a roof or something. There was some structural work that was needed, and they got 5 grand or something, or 10 grand. I can't remember the exact number, and they managed to fix their roof. So like that's pretty cool concept. My kind of personal experience with this, there's sort of two that I can think of. So behind me in my cabinet, if you're watching my video, watching the video feed, there's a couple of albums down there from like musical artists. Now, they're like in box sets, really nice kind of presentationally done. Like a few discs, there's posters, there's all sorts of really cool stuff. But those couple that are down there were done through a crowdfunding platform, and it could be that those products never, would never have come to light had the artist not done a crowdfunding scheme and obtained a load of money from their fans to then go and produce that. So for me, like that was something that we did quite a while ago now, definitely pre-COVID. And the other one that's quite popular is video games. So the one that I'm thinking of, and I may be slightly incorrect, but Shenmue, which was a really popular game on the Dreamcast back in like, I don't know, late 90s, early noughties, that I remember playing. It's like an open world RPG. There's Shenmue and Shenmue 2. Shenmue 3 came out maybe like 5 years ago, but the only reason that game was made was because there was a clamour. The two original games were like made within a few years of each other, and then there's like a 20-year gap for the third one to be made. But that was crowdfunded, and they said we've got a concept that we want to make the third one. It might have been the original developers, a lot of the original team. They had a concept, they had a story, and they were like, this can only happen if we can, raise finance or raise money. And it's quite a cult game, so like all of these people just like jumped on board the crowdfunding, and they had some targets, and they absolutely smashed the targets, and the game got released. So yeah, I think in terms of like weird and wacky concepts, there are definitely some out there that probably Clive was alluding to, like that water bottle maybe, but there are tried and tested things from, I guess, established organisations or artists or companies, but for whatever reason they haven't got the money, or they might think it's a risky concept. So rather than kind of going ahead with something and seeing it fail, they're testing the market out. It's no different than having a business idea or having a product or a service and creating a waiting list. If no one joins the waiting list, you don't go through with it because it's clearly not not required or not wanted. However, if you get a lot of interest on the waiting list, then you've got something, and that could enable you to then go to the next stage in terms of actually building out this product or service that has this kind of small following that is attached to it. So yeah, like for me, it's quite a cool concept, and Patreon's similar, right? Like Patreon is very, very similar, and a lot of people want to generate a regular income. So from a business point of view, like as an income stream, it makes a lot of sense. But again, like Patreon for me is kind of like, what cool content can I get back for a monthly subscription, or am I paying a monthly subscription for maybe some bigger kind of concept that this thing is kind of heading towards? So yeah, like for me, crowdfunding is quite cool. Maybe you just need to look at some different things, Clive, with crowdfunding.
I gotta lose the skepticism about crowdfunding, and
maybe it's an Irish thing. I don't know.
I don't know. What else have we got, Neil?
What about, so something that's really common with my recruitment clients is invoice factoring, and I actually experienced some of this when I was in a prior employer. So basically, invoice factoring is getting typically a bank or some form of kind of finance house to pay you money for your client's invoices. So I don't know, let's say for example you had £100,000 of sales invoices that go out in July 2024, but they had 60-day payment terms. Well, actually you want that cash a lot quicker and a lot sooner. So what the invoice factoring company will do, or invoice financing company will do, is they will pay you those invoices within 7 days. They will then recoup the money from your client, But then it's kind of backed with a guarantee. So it's kind of like, well, if the person that you've invoiced goes bust, then you have to pay us back some of that money, not all of it. Some factoring, well, I mean, it kind of depends. The ones that I see are kind of like around 90-95% guaranteed. So they will pay you that money. If a company goes bust, you have to pay 5% of it back, for example. But it enables you to get that cash flow in the business quicker, and then you're not worried about kind of the debt control and the credit control of obtaining those funds, and then you can use those funds to then invest in other things, whether it's people, whether it's and it works for product backed businesses as well, not just kind of service businesses with recruitment. Just recruitment has been quite common for us as a bit of a niche, so it's where I've seen it, and also digital marketing, web development type businesses as well. But it's expensive. It can be expensive. So most factoring houses will probably charge like a standing fee monthly or annually to use the service, and there are kind of transactional rates within that on a monthly basis as well, which are typically a percentage of the total funds. So if you're invoicing 100 grand, you might get that money quicker, but you might only get 95k of it. You probably won't get the full amount when you consider all the fees that are attached to it as well.
Yeah, that's been my experience. So it's quite common as well to sell your invoices to these factoring houses. Like they could be just your banks. It doesn't need to be specific, so long as they offer the service. In the FMCG industry, so I worked for a distributor once, and like they were selling to major retailers, and they would sell all their invoices, and they had a whole team who focused on this. Like it was just a major operation. It was a massive company. Sorry, when I say it's a major operation, it's because of the scale of the company that it was. But basically, you had somebody there uploading the sales invoices to the bank every day, and then drawing down funds every day. And I think they used to get like 75% of the value of the invoices. So it was really good because it meant that they're able to manage the cash flow and balance the need to pay their own suppliers, the manufacturers of the products that they were doing the distribution and selling for, and waiting for money to come in from the retailers, the Tesco's, the Aldis, the Duns of the world. So it's ideal if you have pressures on your cash flow from your supply chain right through to your customer. It can be a really good solution to help smooth out that. What I would say is that while the excellent side of it is that you get immediate access to cash, the downside of it is that you can become dependent on this type of facility. And I suppose as the business grows, you have to be conscious and find a way in which to, what's the word, wean yourself off this type of factoring or this type of debt over a period of time. And how you do that is by minding and increasing your margins, negotiating better payment terms, both with your suppliers and with your customers. And ultimately, what you do is you just try and wind down that over a period of time. So, again, excellent way for startups, especially if they're dealing in volume, to get access to cash quite quickly to help smooth out their cash flow issues in the short term. Just be wary, don't get fixed on it, and try and wean yourself off it over a period of time.
Yeah, and then something else you mentioned earlier around peer-to-peer lending. So that could be between individuals, between friends, family. Typically, excluding something like a bank. So as a result of not having to deal with a bank, generally you can get quicker access to funding through peer-to-peer. You're probably going to get better terms in the experiences that I've had with peer-to-peer lending. There can be, I guess, if you're not dealing with a bank and you're dealing with Joe Blogs down the road, clearly it'd be good if you knew them to a degree. But yeah, there's less regulation, so I guess you could argue it's a little bit riskier. But I would probably say it's riskier on the lender's behalf than the person that's receiving the money. And once you've received the
Yeah.
money, you're pretty much good to go. But like for me, it's definitely, from what I've seen, it's kind of almost like that angel investor type activity. But again, probably for much smaller businesses.
Yeah, absolutely. Neil, is there any chance I could borrow a fiver off you?
What's it for, Clive? Is it for a water bottle?
Oh, it's a good investment, Neil. I promise.
Are you passionate about this water bottle?
Oh, I'm super passionate, mate. It's going to change my whole lifestyle and my whole life.
Oh, that's amazing. Well, I'll let you know, mate.
All
Yeah,
right, all right.
I won't charge you too much from an interest rate point of view, so you should be okay.
You're a very decent fellow, aren't you?
And that's it really. That's kind of like the main ones around alternative financing. And to be fair, mate, we've been going for just over an hour, so I think I don't know about you, but I think we've covered quite a lot there.
Yeah, it's a big topic. Definitely, I'm a big fan of equity financing, debt financing. It's just a bit of a bugbear for me because of the whole personal guarantee. What's the point of setting up a company when these banks ask you to sign a personal guarantee? There's not that sharing of risk where there is with equity financing. I think we've covered loads, and I'm really excited to get a deeper dive into these. If when and Sam from Swoop can come on board once the funds have been transferred for the appearance fee.
Right? He sent me
No,
he sent me a WhatsApp. Shall I just read a little excerpt from his
if
WhatsApp?
you're allowed to.
I don't think I need to pay to kind of say this. So he said, amongst other things, which is private between me and Sam, he said, "I will support you with anything, my friend." So there you go. So
Oh,
there you
okay,
go.
okay, very
So
good,
we
very good.
we will get him on board. We will talk more in depth around not only like how Swoop can like help directly, but just in terms of like the market. And I know like someone like Keith, for example, that was watching this morning, like he's got an idea. It's a really cool idea. And so we need to kind of just say, okay, we've given a bit of a brief explanation here, but actually, for the guys that are seriously wanting to go down this route, like what are the options? What do they need to do? We've not discussed anything about business plans, around personal credit, around sets of accounts, any of that kind of jazz. We'll leave that for the more detailed session.
Absolutely, absolutely. Because there's loads more to go into, particularly around how to set yourself up to make sure that you have a successful application for debt financing or for equity financing. Not touching on that today. Don't want to give all the sweets away in one go. I want to save a little bit for that episode. Don't know when that's going to be, but let's see if we can organize that sooner rather than later.
Yeah, yeah. And there's no kind of special challenge today, Clive, because as I hinted at before, I've been pretty busy and I've not really thought about anything wild and wacky to kind of test you with.
That's okay.
So
That's okay.
we'll just have to leave it for this episode. I will do something extra special for the next one.
Yeah, just trying to think of something to so it's my turn to host on the next one. So I'll come up with a little fun challenge for you, and hopefully you're not too upset after Sunday as well. But look, best of luck to them. Um,
Come
I
on,
don't know.
England.
Enough of that, right? Enough.
So I'll see you in if I don't see you next week, Clive, because I'm in Dublin on holiday next week. So if you're around, mate, a cheeky little beer, perhaps.
Sounds good.
I'll see you in 2 weeks. We've not got a theme or a topic for 2 weeks' time, but I'm sure we'll think of something.
We have loads of ideas. It's just about picking which is the right idea to run with first. It's like too many ideas in the bag. But anyway, we will be back in 2 weeks' time. A massive thanks to everybody who tuned in live. And Neil, you had some comments and stuff from people that were viewing, so I really appreciate that as
I
well.
did. Yeah, thank you for everyone that's tuned in live. I frantically written down some comments there, replied to some people. Chris says it's a hat trick for him, 3 in a row. So thank you for watching, Chris.
Nice.
And yeah, if you're watching on replay, which I think Ryan, who was on the podcast a few weeks ago, he's going to be checking this out afterwards. If you've got any specific questions around financing, either what we've covered or what we haven't covered, then please let us know because we'll factor those into the next session that we do with Sam from Swoop. That'd be great for us to get. Cool.
Okay. Thank you very much. Have a
See you
good
later, Clive.
weekend, guys.
Take care. Bye all.